Hi, Ben.
Hello.
I want to talk about something that happened in 1987.
Oh, that interesting year. Yes.
Yeah, it'll be interesting because it's important going forward.
Yes, it was.
But before we dive into it, can you give us some background into your family investment philosophy and history?
Another interesting subject. There's a little tidbit of information that might be helpful for people today. In this day and age, most everybody's invested. Everyone. I would say probably 70-80% of the adults in one way or another have participation in the stock market. But what's interesting historically is that before the 90s, and mid 80s, early 90s, there were very few people invested in the market, relatively speaking. It was only like 10 or 15%. Going back into the Depression and after the Depression and after World War II, everybody left their money in the bank. It was you put your money in the bank and you invested it through the bank and that sort of thing. But no one had stocks and bonds. It was the rise of the mutual fund that really brought a lot of people into the marketplace, into the stock market. And then the retirement plans and the IRAs and all the rest of it through the mutual funds came into it. And I bring that up because both sides of my family, both my mom's side and my dad's side, were involved in the stock market. And I mean back to the 1920s. And so to have less than 15% of the American people invested in the stock market and then have both sides of your family invested is kind of a unique situation. And so I'll tell my dad's side, because my grandfather, who unfortunately passed long before I was born, was a wild and crazy fellow. He became a pharmacist and all that, but he was in the stock market in the Roaring 20s. And how he got, and he was a young man. My father was born in 1930, so in the late 20s. My grandfather was a young man in his early to mid 20s, and he was a charismatic character, and he worked in the pharmacy in the big department store in Louisville, Kentucky. He lived over in Indiana, but he worked in the department store there, in the drugstore. And the owner of the department store really took a liking to my grandfather, and he came up to my grandfather. Probably, I don't know the exact dates, but the family story has it was like in 1926, in the middle of a Roaring 20s. And this owner, who, as the story has it, knew a lot of people in New York, had a lot of contacts, and he says, "Young man," to my grandfather, "do you have money?" And my grandfather says, "Yeah, I've got some money put aside." And he says, "This is what I want you to do. I want you to go buy some stock." "Okay, what should I buy?" And the fellow gave him a list of all the stocks he had to buy. So my grandfather, not really knowing what he was doing, dutifully went out and bought these stocks. Then I'm sure anyone who knows any history of the stocks and the Depression, 1929 comes around. And it was at the end of 1929 that all the things started happening that led to the Depression. And the same fellow, and he'd worked, my grandfather had been working with this fellow for some time, for four years, and he had continued to buy. This old man came to him and said, "Do you still have those stocks?" And he says, "Oh yes, they're doing great." And this is in the first part of the year, okay? And he says, "Take it and sell it all." He goes, "What?" "Yeah, get out of the stock market. I want you to sell all of it." So what my grandfather did was, by that time he had made quite a bit of money. So he sold all of his stocks and had a huge chunk of change. And this is back before the IRS would take, 40% of it. The IRS had already come into existence back in 1913, but it was still only on the one percenters. It hadn't worked its way down to kill the American, middle class, which, by the way, when the IRS was brought in, they said, "Oh, it'll never be applied to the average person," and it'll only be on the one percenters. Yeah. Last time, let me ask you, whoever listening, if you're in the United States, are you in the 1%? And are you paying income tax? Well, there is, I won't go into too much of the lies, but that was one of the lies. So my grandfather sold this, and he kept it. So he said, okay, what am I going to do? And he saw over in New Albany, there
Was that in Indiana?
In Indiana, right across the river from Louisville, Kentucky. Mm-hmm. He went over there, and this drugstore was for sale. Says, I've got the cash, you've got the drugstore. So he sold, having sold all the stocks, he went into the drugstore. And then, as everyone knows, to the end of 29, things started going kaplunk, and it went big kaplunk to start with, and then it kept on going, and the second big kaplunk happened in 1932. But my grandfather was out of the stock market, and he had an ongoing little business. And it turns out that with his degree in pharmacy and having the little drugstore, that carried my dad's side of the family through the entire Depression. And in fact, by the 1940s, that drugstore was making a great deal of money, and my grandfather was doing really well with it. So that was my dad's side, and he was the wild and crazy and that sort of thing. Now my mom's side, which was much more old line, stable, and that sort of thing. My grandfather on my mom's side started out
This
as
is her father?
Her father. He was the principal of a little school, which basically was from first grade to the all the way up in the 1920s, and all the way through.
In Missouri.
In Missouri, okay. It was up in Bland, here in the right in the heartland of Missouri, and up until 36, he was a principal. Then, when he was early 30s and had a family and 3 kids, he upped and quit the principal and went and got his degree in medicine. And for 3 years he went and got it. But what was interesting is no matter how little or how much he was making, he started in the 1920s, and he started buying stock, bought stock and bought stock. And I forget the fellow who he was following. It was an advisor. He followed him for 35, 40 years. And would
that be somebody that the world had heard of, or is somebody
yes,
just local?
Yeah, it was someone that if you're in the finance and you knew history, you would have known. He was a fairly famous advisor, and it wasn't. I'll talk about Benjamin Graham here in a moment, but it wasn't Benjamin Graham, but kind of like that.
I kind of wondered if it was him. Okay.
No, it wasn't him. It was someone else, and he got his letter. Dad would know it, and I forgot to ask him who it was. But basically, throughout the late 20s, he bought stock. Stocks went up, he kept buying. Then when 29 to 32 and the whole bloody thing collapsed, he just kept buying. And what's interesting is that if you sold and you stopped buying at the 29, mm-hmm. It wasn't until 1958 that the Dow came back to where it was in 1929.
Wow. Okay,
it took that long. So if you bought in the late, in the Roaring 20s, and then you stopped because everything was wrong, and you were waiting for it to rebound, you'd be waiting until 1958 after World War II, and as we went into what was called the go-go years in the 1960s. But what happened is that my grandfather kept buying. So as it went down and down and down and down and hit way bottom, he was buying at the bottom when absolutely no one was buying him because they were, oh, I've lost everything. But my grandfather just kept buying. And I think within 5 years, he had recovered because he bought all the stuff that was high, but he was also buying a whole lot more at the bottom. And so even with the Depression, by World War II, because he kept buying at the low, taking every dollar he made, he put 10 cents in to the stock market. By 1940, he was out, and he had enough to buy a house and go to medical school. So both sides of the family benefited from the stock market. My crazy grandfather on my mom's dad's side, was wild and flamboyant. My mom's side just kept buying and buying, and both my grandfather and his brother retired. My grandfather was a doctor.
Mom's.
My mom's father retired as a multimillionaire, practicing medicine in a small town. His brother, who also retired wealthy, was only in high school, taught physics in a high school. And that's all he did. And he followed the same advice that my grandfather was. They followed the same advisor. And over the years, they would just put the pennies away and buy and buy. And they were buying on the productive capacities of the growing economy of the United States. And by the mid-60s, they both retired. Well, my grandfather, he was a workaholic, and he worked until 1970s. But both of them were well off, and not by putting it into bonds and all that. They invested in stocks the way historically it was done. So when I came along, and my dad followed my mom's grandfather. He kind of looked at his dad and realized he was a wild and crazy guy. And
You followed your mom's father?
Yes.
Okay.
His stepfather. Mm-hmm. He sat, and when he met Mom, learned. And my grandfather on my mom's side gave my father books and information to read as a young man when he married my mom. And so he dove into investing the way that my mom's family has done. And so that's my history. My history goes to my mom's side more than my dad's side. But my dad fell into that and really took it. And so when I came along, and when I was 13, 14, when I started, getting a little more mature, he started feeding me this stuff. And one of the books he gave me was Benjamin Graham's The Intelligent Investor. And it's a book that is incredibly powerful. And for those who have never heard Benjamin Graham, one of his greater students was Warren Buffett. And Warren Buffett learned at the feet of Benjamin Graham at Columbia University. And so that's the mindset of my family. And so we always looked at not at investments or stocks as a speculation game. We didn't look and say the greater fool theory, or okay, you buy the stock today and hope next week or next month or next year you'll find some greater fool that'll buy it at a higher price. What we always looked at, following Benjamin Graham, is you buy, you look at the stock, you look at the PE ratio, price earnings ratio. I won't go too much into that, but historically that's always 8 to 10. And my dad, after the go-go years in the 1960s, the market dropped in, and it was called stagflation in the 1970s. And so we were buying stocks. And McGraw-Hill, in 1974, the PE ratio, the price to earnings, was 4. It had been I forget how long McGraw-Hill, the publishing company, had been around forever. And here it was selling at a PE ratio of 4. You could buy stocks, not fly-by-night operations, but serious companies with a PE ratio of 4, 5, and 6. And so when I was growing up in the 70s, only once did the Dow get above 1,000. That was in 1973 or 74. And then it crashed. And then towards the late 70s, we would watch it. And I would sit, and my best friend would come over, and we would sit with my dad and watch, there was a nightly business report.
Is it called the Lear Report?
That was, I think, on the weekend, but it was called the Nightly Business Report on NPR.
I kind of remember it.
Yeah. And my best friend and I would sit with Dad. Dad would get home, and we would turn it on, and we would watch that was the total we either had the Wall Street Journal, the Barron's, and then also the reports. So I sat for 8 years in my teens watching the stock market, and I'd occasionally get up to 1,000, and then it would collapse. And then it would go up to 1,000, and then it would collapse. For 10 years, this would go on. My dad was like my grandfather, buying and buying and buying. And it was and he was making money. These companies were paying dividends. Most of these companies nowadays, if they pay dividends, it's not like what they did back then. The price earnings ratios are good. The dividend return. Individual stocks, if you chose the right ones, slowly showed a nice price increase and that sort of thing. And so I sat there and learned in a world that I still consider sane based on what Benjamin Graham said. And in fact, in 1980, the stock market was still 830 points.
What year?
1980.
Oh my
It was 840. Now it's 23,000. 830.
Wow.
Then it started going crazy. So, but basically, that was my teenage years. That was my history.
So you have quite an education.
Yes, and Dad made sure that I read Benjamin Graham, an absolutely brilliant book. It should be for every intelligent young person. It should be a required reading, because when you go out into the world, you need to know what the investment mechanisms are and how they are.
Yeah, it's not part of our education.
No, so that's what I grew up with.
Okay, so now it's 1987. And your family was seeing some interesting things happen in this stock market.
Yes.
What is it you were seeing?
All right, like I just mentioned, 1980, it was 830.
Mm-hmm.
We watched it for a decade, and it never got above 1,000. Then suddenly it started to go up, and I think it was 81 that it crossed over 1,000. And for 7 years, it just kept going up and up and up. And we watched, and it wasn't like the 1840s, and we'll eventually talk about the age of 1001 beginnings that was created in the 1840s. It wasn't that kind of growth. The PE ratios, the stock, the companies weren't expanding in proportion to their prices. And we saw that it had gone from the historical concept of you invest, it's an investment. It produces money. Companies make things and sell them, and you get a little part of the profits of that. It went from that mode to the sucker theory. That, look at, and Dad taught me all bull markets, the rising markets, start against an overwhelming pessimism. And in 1980, there was overwhelming pessimism. No one would touch the stock market. It was ridiculous. And then it started going up. And Dad always said, optimism, a bear market always starts against an overwhelming optimism. So in 7 years, we went from this incredible pessimism to staggering optimism. We watched the interest rates in 1980 go, it was at 18%, 12% at the, and then it started dropping, and then the market started going, and optimism. And so by 1987, no one thought, oh, the stock market can never go down. And Dad, who lived through the 1960s, which was called the go-go years, which was the equivalent in some ways to the 1920s, is going, hey, 18 years ago, back then, we had this go-go and then crash in the late 60s, and everybody lost their shirts. And now you're saying it again? I don't think so. But by that point, these things called derivatives had come into existence, called puts and calls. And I won't go into what puts and calls are, but puts allow, except to say that puts allow you to buy an agreement to buy a stock at a fixed price. And so you give them money to, for a short period of time to be able to buy the stock. And we bought these dirt worthless puts. We've created, my dad, I'm getting a little ahead of what we did into what was called.
Yeah, because I want to talk about the partnership you formed.
Okay, yeah.
Or was that after you actually started buying?
No, okay. I'm getting a little ahead of the story. So Dad was going, and I was agreeing. When we went into 1987, all the classic signs were there. Dad would talk to people, and he was a doctor, and he would talk to the surgeons, and he says the surgeons were classics. They're brilliant, at doing surgery, but when it comes to it, Dad would walk in, and the surgeons would always have, because they're making all the money, and they would be going, oh, what's the newest phrase and craze and all of that, and all the surgeons would tend to be in it. And Dad would walk in, and he would talk to the surgeons. And they're all in the stock market. 10 years ago, they wouldn't have touched it with a 10-foot pole because Dad would be talking about them, and they go, oh, no. They'd be off doing other things. But now they were all in, and Dad said, don't you think it's getting a little high? Oh, no, it'll never go down. It'll never go down. And Dad's going, uh-oh. This is very, very interesting. So that he was seeing the optimism. He saw the PE ratios collapse, and he says, Ben, something's going to happen. And that's how we went into 1987. So
okay. So what did you decide to do about it?
All right. There was a few friends that Dad was talking to. And he was saying, this doesn't look good. And there was another young fellow that you'll hear more about.
Do you want to say his name now?
Yes.
Okay.
Matt Mazer.
Okay.
And how we met Matt Mazer is he was the boyfriend throughout all of high school, or a good part of high school, of my youngest sister. The one that unfortunately passed from a terrible skiing accident. But he stayed close with the family. And so Dad was talking about this, and Matt had gone, he just graduated from Brown, I believe. So he had been in business, so he was listening, and he was understanding. And then there was myself, and then there were three others, two of my dad's friends, and my best friend, who was the one that sat and watched the business reports. And we said, let's form a little partnership. And we go, okay, well, we might be able to buy some of these puts way out of the money. I mean, they were so far out of the money, the sky would have to fall before they would get to be anything. And we could pick them up what was cost a 16th. We were buying them at a 16th, so you multiply it by 100. It was like these contracts were costing us $6 for controlling 100 shares of the S&P 500, which was a huge amount of money. So we said, let's buy. We'll find a little partnership. And there are 6 of us. And I can't remember for the life of me why we said M. It sounded probably pretty cool. 6M partnership. So we've...
Maybe it's a play on 3M.
I think you might be right. Now that you mention it, we knew, because we all knew about 3M, Minnesota Mining and Manufacturing, 3M. So I think that is part of what went into it. So we formed the 6M partnership.
Very clever.
Yes. So that's what we did.
All right. And so what was involved in the partnership? What did you do?
Okay. Each month, and a couple of them they took half shares. They were full partners. We were all general partners. And Dad was running it because, he was the one that understood all of this. And so we each agreed to put in, I think, $500 a month, but a couple of them said, can we only put in $250? So it was really, there were 5 full shares in this partnership. And I think over 4 months, we put in, I think we each put in about 2,000. So we had about 8 or 10,000. Now that I've been thinking about it, it was about $8,000, $10,000 that we got in. And this was starting in May or June. May. And we went out and we bought these what are called S&P 500s puts. And I think the stock market was at 3,200 or 3,500, and S&P was at 1,000. So we were buying them like at 600, 500. And so we were getting them for dirt. And they were only good for 3 or 4 months, 5 months. So the sky and the stars would have to fall for these things to get anywhere close to what is called in the money. So we bought them. We bought some the first month. And we were out as much as 6 months on them. 3 to 6 months. Then June came and we bought some more. And then July we came along and bought some more. And finally August we bought our last ones.
Were they good for a couple of months?
And they were all good for 4. And we had at that point we had $1,500 or $2,000 worth of these puts. Some of them had already kind of gone bad by August. And so we were sitting with these things. And it started showing the classic topping signs. And
can you tell what those were? Because I don't know what they are.
A topping, it means that the pattern of all the big stocks, they would rise and then drop, rise and drop. And they're kind of standard patterns that it's called the topping pattern. That especially when it's not an investment market, it's a speculation market. So what's happening is you're starting to run out of suckers, as it were, as Barnum and Bailey said. You try to run it up to encourage people. Oh, see, it's still going up, and you'll get some to sucker in. But then the buys to sells, there are more sellers than there are buyers. And what happens when there are more sellers than there are buyers?
things just start to topple.
So that's what happened, was they were starting to run out of sucker market. And so what happened is that it started topping in August. And then the economy was showing some difficulty, and so the Germans raised the interest rates. Those Germans. My mom's side of the family, those Germans, so sweet.
I'm all German too.
Yes. But they were having some difficulties in Germany at the time. There was stagflation, worldwide stagflation, and so they were. We followed suit. We had followed suit, some years before, but the Germans had lowered it to the point and had really pushed so much into their economy that it was starting to show. And so what happened is that, and it wasn't just the United States that went up; all the world, industrial world, had followed suit, and so they started raising the interest rates, and then things started getting really interesting. And then we went into September, and it started kind of going down a little bit, down. And then we went into October. And the week before Black Monday, that optimism that Dad had run into, and everybody and all the rest of it, and all the news, and everybody was saying it was never going to end. Oh my gosh. It started, and that the week before, the stock market really sank, and it got everybody scared. They went from being truly optimistic to, oh my gosh. And our assets, our total value had climbed to 150 to 200,000 at that point.
This was where in that period?
It was the week before.
Okay.
Black Monday.
Okay.
So Dad said, we'll sell 20%. So, and it turns out that one of the partners, unbeknownst to us, bought into the partnership just kind of as a lark, but who was on margin on the upside. So they were getting calls because they had leveraged their home and all the things, and they had gone on margin on the upside. And so what happened was they were coming to my dad and saying, we got to sell now. And my dad said, well, yeah, we're going to sell a little bit, so we'll get 50,000 and we'll spread it apart. So you sold 50, and that gave everybody a little cash. And so if it went up, if the stock market recovered and went back up, going from 5,000, 10,000, 1,000, 1,500 to 50,000, that's.
So they would have got their money back at least.
Oh, we would have had a tenfold return on our money.
Even with that selling that 50,000?
Yes.
Okay. So they should have been happy.
Yeah, well, but that gave them enough cash to, I think, help cover their lot. But they were still pushing my dad, pushing. My dad said, "No, this is not over. This is not over." And I'll never forget. So that week just was ugly, and Dad sold at the bottom, on either a Thursday or Friday of that previous week, and got the initial cash. But boy, oh boy, the rumblings that were going through the financial markets that weekend. And what was interesting is I'll never forget this. I was helping my grandparents on my mom's side. They were living in California by this time, but they had a house in still in Union, Missouri, where my grandfather had practiced medicine for 40 years. Mm-hmm. And my grandmother made some reservations, and I had the opportunity and time, so I was going to take her back and so I was going to oversee her, make sure everything was all right, and then go see the house, and maybe I helped work on the house. And so it was that Monday We were going to walk. I was going to climb on a plane at 8:30 or 9 o'clock in the morning and fly to St. Louis, which was very fortuitous, because normally I'm not in places where there are lots and lots and lots of people.
Mm-hmm.
So we had already packed, and so in the morning I turned on the television, which is 3 hours back
All right.
from the East Coast, so the market was open. And we woke up, and the market was already 500 points down. It was just collapsing. And I think that there were probably 24 people in the world, maybe 100 people in the world of finance and money that had played these kind of things, that were happy. I mean, here I was looking at this thing, and I was watching this, and everybody on television was horrified and terrified. When you walked out into the street, it was like gloom and goom. And here I was starting to add it all up. I was going, you're trying to figure out how much these puts had gone, because no one knew where the bottom was. So they were marking these things up. Our 16th, we bought for a 16th, our average sales price was $52 a contract. So it went from almost essentially zero to 52.
Wow.
And we ended up making, I think, well over $1 million. And it was interesting because when I walked through the airport, and this is really, if I remember right, this was before they really had televisions and CNN and all the rest of it. But
hanging everywhere.
But you walked into that airport. And this is before the TSA and all the rest of that nonsense. And you walked through the airport. It was like the world had ended. It was all these businessmen, and you'd never seen such dire, horrified people in your life. And here I was going, didn't you buy puts? You should have bought puts. I wasn't saying that. But I walked away with 220,000 because there were only 5 shares. So 5 whole shares. And so we split, I think, 1.2 and 1.3 5 ways. And so it was...
That's a lot of money, especially in 87.
87.
It may not seem like a lot now, but a lot of time has passed since then. So
yeah, there were no billionaires.
It was a lot of money.
There was no Bill Gates. This concept of billionaires,
Mm-hmm.
that is a product of the 90s and 2000s and all the rest of it. There weren't these mega wealthy. The financial wealth, which is what they're measuring, had not exploded yet. And so there weren't billionaires. So if you had tens of millions of dollars or hundreds of millions of dollars, you were very, very well off. So 200,000 at that point was a good amount of money. It would be equivalent to taking $5,000 and making $2.2 million or something like that in today's money. It was, overnight you just go from one to the other. And back then the economy, the market, and the world was more stable, so it didn't have this rapid rise and collapse of wealth. You're seeing this, people make $100,000 on YouTubes and that sort of thing. But they turn around and lose it just as fast. We're seeing an increase in volatility within our civilization with regards to wealth measurement and all of that. Sign of a decaying time, of financially distressed times. And that wasn't happening back then. It was a different world. So.
Okay, so let's pull this back into your own story. You've got some money in your pocket now.
Yes.
What's going on in your mind? You're going to go buy a new car and travel the world? Or?
Oh, no. No. The next thing we did, and looking back on it, we were very, very lucky. I mean, we were right on our ideas. And Dad has never, ever been wrong on the trends, the ultimate trends in the marketplace. And I've having learned from him, and then also Professor Galambos, I can see the long-term trends. Timing, it ends up being sheer luck. And we were just really, really lucky to have seen that. It was 25% of insight and 85%, 75% just pure luck. So what happened was that I went and I played, or of all things, if you've ever seen Trading Places, they play in that movie. It came out way, way back in the 80s or 90s. And it was all about orange futures. And so we saw an overpricing of the orange futures. But we played it, and I took 30,000 of my 200 less the taxes on it and all that, and I played the stock market, which was a very good lesson for me, because speculation is not an easy thing. It is to do it well and do it on a reliable basis is a very, very difficult, and it was a very good lesson for me to learn that speculation, as distinguished from investment, is a dangerous thing. And if I can tell anybody out there in the world today, we are living in an age of speculation, and it can eventually catch any and all of us by surprise. But I learned my lesson by playing the orange futures, and we were right. The insiders kept pushing it up. And so we would get down, and then they'd sucker us, and then they'd push it back up. And a true speculator doesn't try to guess the trends. He just follows the trends. That was the thing I learned. And we didn't have the technology they have today to follow, be able to speculate. So lo and behold, we played it for about 4 months. We all lost, some thousands of dollars into it. And then what happened was that we said, okay, enough is enough. And about 4 months later, it did exactly what we had anticipated. And if we had hit it right, we would have taken 30,000 and turned it into close to $1 million. But it was not to be so. So I learned my lesson in speculation. So now I was still left with a very big chunk of change. And I said, okay, now I have an opportunity, and nowhere near what is necessary to do what Professor was wanting to do. But I had the capital to help set a company going. And looking back on it, I shouldn't have gone. I was always shooting for the fences, because I knew you had to produce a huge capital base in order to finance all the mechanisms that are in V201. It's a capital intense thing. Once you get it all set up, then the technologies will be able to flow back. Like these computers we have today cost tens of millions of dollars for systems that were vastly weaker than this, and only a few people could do it. But once it grew and expanded, then we all are surrounded by computers that would make the computers of the 1960s, 70s, and 80s look like jokes. And we paid hundreds of dollars instead of millions. That the same thing was going to, we knew it will eventually happen with Professor's Technologies and Sciences, that you can run a hot dog stand on a gratitude mechanism once it becomes a universal system. But you can't build it on a hot dog stand. So I said, okay, 100,000, I could go out and buy a small business and that sort of thing. But it won't get me to where I needed. I needed to hit a home run so that we can have the capital. Back then, if we had 10, 15, $20 million in capital assets, we could be in a position then to start doing it. But the other interesting thing is to do what Professor needed. He knew it, and he knew it in the 1960s. He said, to build a world of stability and peace, it will build upon the back of computers. Computers will only be through computing capacities that we will be able to do this. And he knew computers because he was writing, I think I mentioned the other time, that he was writing the equations and working out the equations for optimization of first stage rockets, and he wrote his programs and his algorithms in such a way so that it could be transferred to computers. This was in 1958 or 59, and they had computers, but he didn't have access to what we take as granted. So he had to do it by hand, but he was writing it in such a way that it could be transferred over. So in 1958, he knew about computers and their nature. And he was saying, this is the way that we are going to have to carry out the calculations. Calculations are much more difficult for P1 than P2, or intellectual property than physical property. And physical property, that's why IBM became so wealthy. They did the computing calculations for the businesses to keep track of the physical and financial. It was going to be required much more than that. So in 1987 and before, computers were still too expensive. So a big chunk of that money would have to go to the capital. So we are now living in a much better world if we can ever get it going, because we don't need nearly as much money because computers are cheaper. But back to what I was saying, in 1987, I needed tens of millions to do what Professor was talking about. So I had 100,000, and I said, okay, where do I swing? What do I do next? And I learned my lesson. I can't speculate my way to it. I don't have that mindset and capacity to speculate my way to the money to then produce it. So I started looking around, and that's where I was in 1987.
Good place to end. I think in the next video we'll start talking about how you started to implement those ideas and use that money to bring about
The change.
volitional science.
Volitional science.
All right.